Okay, so today is Wednesday, July the 9th. The market is closed. It's a bit past 2 in the afternoon Pacific time. And I want to spend a few minutes going over a spreadsheet to cover a concept. This is basically going to be an explanation of why selling a covered call is not a vehicle to produce income. And you hear a lot about that on many videos, YouTube, where you can create passive income, produce income, make a little bit of extra earn by selling options. And in this case, it's specifically selling calls, selling a covered call. So you own the stock and you sell calls against it. All right, for this example, I'm going to use prices from a position I already have. I have a position in HIMS, just 100 shares. Average price is $46.52. Now, I've danced around this position quite a bit. Let me see. So I'm not going to cover all of that because it's too much. But let me fire this up. Okay, so I have a position in HIMS. Here's some of what I've had going on. The average price is $46.52, and then I've been in and around that price with various options, puts and calls. Put side options were to provide downside coverage, so insurance, so to speak. And then I did trade some calls in there, covered calls, which I decided I did not want to do, and I reminded myself why. Here's an example where rather than selling a covered call, I actually sold shares of stock. I sold 25 of my 100 at a price of 50.6, and that was earlier today, and that brought in $1,265 on 25 shares, and then I rolled up some puts. All right. Anyway, let's go back to the example in the spreadsheet I'm going to focus on for the next few minutes. So here, let me cover this real quick. We have 100 shares of HIMS that I purchased at $46.52. And in this example, I'm going to use a put vertical, a bearish put vertical. The strikes will be 44 and 40. The expiration date of 7/18, July 18th. So we have about 9 days to go for that. And the price that I paid for this put spread in this example is going to be, what do we have here? $1.62. Okay? So you have 100 shares of a stock, HIMS in this case. You have some downside protection via the put spread. Again, the strikes are 44 and 40. So let's go over here so we can look at some of the numbers, do a bit of number crunching, and compare tweaks in the structure of this position. So this column N, this is going to represent not just the value of a put at various prices for the underlying, but the actual P&L. So as an example, if I go down to cell N7, we're going to see here that with an underlying price at expiration of 35, the 40 put that I sold is going to have a P&L of $307. It's actually going to be negative 500 is the value of this put, but remember I received a premium of $193 for it. So the total loss on just this the 40 strike put that I sold is $307, and as we scroll down, we'll see that at prices of 40 for the underlying and above, I keep the entire premium of $193. All right, for the 44 put, which I bought, in this example, I paid $356 for it. We'll see that at an underlying strike of $35 at expiration, the value of the put is going to be $9. However, I paid $900. However, I paid $356 for it. So it's going to end up being, it's going to have a P&L of $543.90, and as we increase in price, this will increase by $100, or the value, the P&L of the put will decrease by $100. When we go above a price of 40 at expiration for the underlying, note here that at this point, this put goes into the negative, with the most we can lose being the debit that we paid of $356. Okay, in addition to that, in column P, we have the stock that was purchased for an average price of $46.52. So when the underlying when the stock is the underlying. When the stock is trading at 35, we have a loss of $1,152. At 40, we have a loss of $652. So it's simply the average price of the stock relative to wherever it's trading. Stock price goes higher, our profits start to increase. Now, in this column, I have the net. Okay, so the net includes the protection via the put vertical and the stock. So with the stock underlying trading at $35 at expiration, rather than losing the $1,152 that would be the loss had I only had the stock, I'm going to lose a little bit less. Loss is going to be $915.10. Let's increase the underlying price of expiration to $40 a share, and we'll see here that the loss with the put vertical is going to be $415 as opposed to the $652. Okay, now let's add in something else. Let's say that we sell a call and we use the 55 strike, and we're going to use a premium received for selling the call of 90 cents, which is going to be $90. That's simply the premium on the call times the multiplier of 100. So now we pick up an extra $90 here. So going back to our underlying price of 35 at expiration, rather than losing $915.10, we're going to lose $825.10 because of the extra $90 that we picked up. And notice that as as the price of the underlying increases, hypothetically, we're going to be losing $90 less because we have this call that we sold. All right, so let's continue to increase the price, and let's say that at expiration, the price of HIMS is at $55, which is exactly where we sold the call. So we have a profit on the stock of $684.90. The call that we sold for $90 is going to expire worthless. So that's going to make our total profit $774.90. Now remember, we did have a put vertical spread, a put vertical that expired worthless. So that's factored into this net because it's the net of the premium that we received for the call, profit on the stock, and the put vertical. Okay, so at $55, this is the net. Now note what happens above $55 for the price of the underlying at expiration when you have the covered call, your income producing vehicle. Look at how this manifests above $55. Well, your overall profit's not going to change no matter how much higher it goes, because you're short this call at the strike of 55. So you've eliminated the upside profit there. You are capped. You are capped profit-wise. Okay, now let's say that rather than selling the call at the strike of 55 for 90 cents, you just sold 25 shares of the stock. And I'm using 25 shares because we are going to, in this example, say that this strike, when we sold it for 90 cents, had a delta of 25. So the share equivalency for the underlying would be roughly 25 shares. So now we did not sell the call. We decided to sell 25 shares instead. Okay, and let's look at what happens here when we sell the 25 shares at an underlying price of $35 at expiration. We're going to have a loss on these 75 shares of $864. Okay, and as the price of the underlying increases, our loss will diminish and eventually we'll reach a profit. But let's take a look now at what happens when we have the 75 shares that we sold and the hedge. What's the overall loss at an underlying price of $35 at expiration? Well, now we're losing $627.10 as opposed to the $825.10 had we structured this with a covered call. $825.10 versus $627.10, and this includes 75 shares and the put vertical spread as protection. And if we continue, we're going to see that as the price of the underlying, if it were to close at a higher price than 35, our profits, our losses will diminish. And let's look at how it ends up compared to the net of having a covered call. So at an expiration price, or at a price of $40 at expiration, the covered call loses $325.10, and the 75 shares with the put vertical and not having a covered call loses $252.10. So it loses less here. Let's continue. Let's increase the price at expiration. Let's go to $50. And note that at $50, the covered call structure does better because the profit there, the total profit there is $274.90. The put vertical expired worthless. The call that we sold for $90 expired worthless. And we have a profit of, what is this, $348 for the stock itself. Now, the other side of that, the comparison vehicle, is the 75 shares instead of having 100 shares with a covered call. Now note that the profit for the 75 shares here is less. It's $97.90 versus $274.90. And let's continue to simulate an increase in price at expiration. At $55, which is where we sold the call is going to expire worthless. The put vertical is going to expire worthless, and you have a nice little profit on the stock, the 100 shares of stock. So your total there is $774.90 versus $472.90 for the 75 shares and the put vertical. And this is the point where they say, hey, well, why would you sell 25 shares instead of selling the call when you can make $300 more, $302 more by selling the call? Well, this area at 55, which is the apex profit for the covered call strategy, that's hitting bingo on the roulette wheel. You happen to pick the right number. How often is that going to happen? Take a trip to Vegas and start throwing some money down on whatever number you like, or numbers at the roulette wheel. See how that goes. It's probably not going to go well. You might win a lot of money, but if you keep doing that, you will have no money. In fact, you will have no money and a lot of debt. All right, so here it gets interesting. Now let's look at the 75. We're still doing the comparison, but here I actually set this up in column W, where we have the difference in profit between the 75 shares versus selling the call, which is the covered call strategy. Let's go back to an underlying price of 35. The difference is $198. So the 75 shares here at an underlying of 35 lost $198 less than the covered call strategy. And if we look back, this is going to be a loss of 627 for the 75 shares versus the 825 for the covered call strategy. So when prices tank on you, the 75 shares does better because 75 shares on a tanking stock is better than having 100 shares. Clearly, you still get the benefit of having the insurance via the put vertical, and that is more than enough to make it a better result when the stock tanks. So you're $198 better off, again, at this worst price in this range of 35. Let's go up the price ladder, and we'll note that at $40, the 75 share strategy versus the covered call strategy is still better. Now both lose money, but the 75 share strategy loses $250, $210 versus $325.10. So again, the 75 shares does better in the lower price range, lower distribution, lower end of this particular distribution. Let's see where things start to change. Now at a price of 44, the put vertical is going to expire worthless, and we paid money for that. So all of that goes to dust. And if we look between 44 and 55, here's where the covered call strategy does better, with the best price again being at 55, because you have 100 shares of stock that you own at 46.52 and now it's at 55, so you have a nice profit there, and the call that you sold expired worthless. So the covered call strategy does better than having 75 shares and not having any calls that you sold. Does better between the prices of 43 and 55, with the apex for the covered call strategy being 55. Now, also keep in mind that HIMS is a very volatile stock. It has super high IV right now, somewhere in the high 90s, maybe 100. And let me show you a quick chart of what's going on here. It looks like in the post it went out a touch under $51. But recently it's been as low as 40, maybe 41-ish, a bit under 42. And they had some shenanigans going on. So this was a week and a half last week, the stock was at 64, and it had this gap down opening where they were getting crushed. Looks like they lost about $17, $18 per share in value because of some shenanigans that they had going on. So this is a very, very volatile stock. It's been all over the place, not just in the last few weeks, but over the course of the last year. So if you have shares, ownership shares in a very, very volatile stock, you'd think that you'd want to benefit from a fat tail move to the upside, which is anything above where you bought it, and the higher it goes, the better. But you're taking on a lot of risk for that upside. So when you sell a call against it, wherever, somewhere in the, you sell a $25 call, a $20 call, one standout call that's a standard deviation away from spot. Why are you doing that in a stock that's so volatile? Why are you capping your upside when you're taking tremendous risk to own the stock? Let's get back to the price comparison here between 75 shares and the covered call strategy. All right, add $60 a share. Expiration, the 75 share strategy structure. I don't want to call it a strategy. Let's call it a structure. It's not a strategy. The 75 structure does better by $73. Let's go up to 65. Now, owning the 75 shares is $448 better than the covered call structure. Let's go up to 70. The 75 shares is better by $823 than the covered call strategy. Let's go up to $75 $8 a share. Having 75 shares versus the covered call strategy, the 75 shares dominates by almost $1,200. And remember that your covered call strategy caps you at prices of 55. This is it. This structure, the way it's set up, the most you're going to make is $775. Touch under. But when you do not cap yourself and you have shares, fewer shares, 75 versus 100, 75 is less. So you have fewer shares, but you still have an unlimited upside on those 75 shares. And at $75, once again, you're $1,200 better off with this structure than with the covered call structure, the income producing structure. You're going to produce income. You're going to produce passive income. Sell covered calls. Now, I'm not saying do not sell covered calls, but there is a time and a place for it. And if you're doing it in a highly volatile stock, you have to ask yourself, why am I going to eliminate the tail on the right side? Why am I going to eliminate that tail where all the profit is by selling a call to bring in income? And how much income did you bring in with selling the covered call in this case? You brought in $90. If you hit the slot, picked your number, closes at 55 at expiration, yeah, that was pretty awesome. But how often does that happen? And how are you going to feel when you see HIMS trading? And I'm not saying it's going to trade higher. I'm not saying it's going to trade lower. I don't know where it's going to trade in the future. But how are you going to feel when HIMS is trading at 75 and you basically send $1,200 to dust? You could have had that $1,200 or more. All right, so it's something to think about.